fourth quarter is upon us here for 2023. It's been an interesting year so far in the first three quarters, to say the least, for the markets. Lots of surprises. As always, of course, the market does tend to travel the path of maximum frustration for most market participants. That is to say, hey everybody, Serge Berger here. Welcome to the Study Wealth podcast episode where we're going to focus on the fourth quarter. I'm going to call this kind of a playbook type of episode. A playbook is only as good as the sort of roadmap we see. If things dramatically change, we will of course update this. So keep that in mind. The markets are ever changing, and sometimes large pieces of news, should we get one in the fourth quarter, we have to adjust course and make a few tweaks, maybe a full 180. It just depends on the markets. What I've learned along the way as a trader and investor over the course of my career is that those people that are most flexible and open-minded, and which is one thing that I think a lot of newbies tend to struggle with, or just people who have not yet reached that level of confidence, is exactly that, right? The inability to adapt, and the need to be right. It's not about being right. It's not about being proven right. It's about being flexible and open-minded and risk managing. That's really what it's all about. So a couple things I'd like to talk about when it comes to the fourth quarter. And as always, I say this at the beginning of every episode, I'm going to show you a couple of charts. I'm going to talk about a couple of charts. If you're not seeing this because you're listening to one of the traditional podcast things, do not worry. It's not the slightest problem. If you're watching it on YouTube, then of course you will see this. I'm going to quickly share my screen with you here in just a second. Let me find the right entire screen. I think it's this one here, so that should do. Essentially, when we talk about the fourth quarter here now for 2023, we find ourselves at a point that's quite different from the past few fourth quarters, arguably maybe more than a few, in that we are, in our view at least, our analysis points to us being very late cycle. I know there's people out there who talk about we're in early cycle, the beginning of a new cycle, but I think we're at the end of a new cycle. I'll talk more about the end of a cycle, meaning we're going to start to see decelerating economic growth from here as the rate hikes bite, which is exactly what they're intended to do. So it would be silly not to think anything different, at least as far as we're concerned. But you have this tricky part of the economy, and again, we'll talk about this in a second. At the same time, we have very strong seasonals when it comes to seasonal for equities, risk assets, right? So this refers to the U.S. equity market, S&P 500 centric analogy here, which, as I always like to say, or have been saying now for a few years, the S&P 500 is essentially a tech index. Have to be just honest about that. So you have those two opposite forces working. I want to be very clear. We want to absolutely respect the potential for a fourth quarter rally. That does not mean that stock has to start rallying October 2nd and then just continue into the end of the year. It's really more a gradual push higher. We don't want to disrespect it. We absolutely want to respect that. But as I also always like to say, I think seasonality patterns in isolation, without respecting where we are in the economic cycle, can be more of a gamble than an actual useful tool. So we do want to keep that in mind. I think that's, at least from my perspective, my experience, that's important. So you've got those two opposing forces. What do you do with it? Either way, we can get a lot of opportunity in this market, that's for sure. But let's take a step back and look at the economic stuff first. So if you were to sort of envision like a curve going up and then down and back up, we're right now, I think we've passed the peak of economic expansion probably quite some time ago. And I think we're heading into economic sort of stagnation, probably recession-ish kind of environment here real soon in the fourth quarter of 2023. There's a lot of things that are happening and coming together at once. Again, a little bit more detail here would help. So one thing, for example, is that just from an interest rate perspective, interest rates have now been going up since March of 2022. So that's, in my math, about a year and a half. And that's very typical, right? Higher rates, particularly if they've been low for a very long time. And in a major exception that we've had this time, where they were basically zero for a long time. And don't mean literally, although in Europe they had basically zero rates. When you have that kind of environment, then you throw COVID in there, it's going to take quite a long time, an extended period of time for interest rates, higher rates, even if it's 500 basis points higher, 0 to 5%, which is what the Fed did. It's going to take more time for that to bite. And so we've been roughly 18 months into it, and I think we're now starting to get to that point. I thought we were there half a year ago. Clearly we weren't, and that's just my misjudgment on part of the fiscal stimulus in the United States. There was $1 point. I don't want to give you a wrong number here to sound even sillier. Huge stimulus packages, infrastructure packages, basically those kind of things. I read that 7 out of 10 new construction jobs are for government projects, not for the private sector. So anyway, those kind of things are offsetting the forces of higher rates to some extent, but ultimately, of course, higher rates will bite. So anyway, long story short, it took a longer time than usual for higher rates to kick in, and this is going to be a problem. At the same time, and this is even more important, maybe in the very near term, we have things like student loan repayment, which has been pardoned for a while or put on pause. They now have to start again, meaning people have to repay those. So it's all coming together in the fourth quarter here, starting in October, basically. What's the risk? Beyond that, we could get a shockingly bad economic data point. We could get a shockingly bad earnings season report from a major company. We could get a default, all which is well within the probabilities of things happening here. And the probabilities of these things happening at this point in the economic cycle is quite a bit higher than if we were not at this point in the economic cycle. I've been saying this now for probably 6 months. And underneath the surface, things have been getting worse, just not nearly as quickly as I thought they were. But now there's even more things coming together. So at some point, you reach that point where things are just getting extreme. So I think we've reached that point now, and that's the risk in the fourth quarter is something that catches people off guard. From a positioning perspective, and this kind of gets us into the next point here, which is where people are. I think a lot of people are just getting to the point where they're getting a bit nervous. And I've been talking about this now for the past few weeks to clients and even in some public presentations, where I think a lot of investors are just now getting a bit more anxious. COVID gave them a lot of free money, gave them now higher rates. So putting money into treasuries for those people that have been smart enough, for lack of a better term, to do that, that's been helping them. But now that they've looked at their portfolios and they realize that we haven't made any progress in 2.5 years, 2 years-ish in S&P 500 terms, which is basically most retail investors' portfolio from a correlation perspective, I think people are starting to get more anxious. But that's just the beginning. That's like the peak of the economic cycle. Once you start seeing a weakening in the cycle, that's when things get worse and worse. Where at some point you get to denial. I don't think we're at denial yet. You're going to get to fear. You're going to get to desperation and panic and ultimately complete blowing out of portfolios. We're nowhere near there as far as I'm concerned. So that's an important part. Now, in terms of flows, and this is why I think, even though, again, I want to be very clear, I absolutely want to respect the potential for a fourth quarter rally in stocks. However, again, there are risks here. So let me quickly go over the fourth quarter rally sort of statistics. And this is, again, what every bull and their grandmother's dog points to. Rightly so, by the way. And this is not, I should not make fun of that. It's rightly so. The fourth quarter is typically bullish for stocks. And this is U.S. stocks, S&P 500 math. At some point in October, whether that's in the middle part to late part of October, we tend to start to get a bid in the market. It's factually over the years. I think this is a 20-year statistic that I'm looking at here, ending in the end of 22, looking back 20 years. So that works. However, when it doesn't work, it can be quite nasty the other direction. And this is important. Now, let's understand why this works. Like, why historically have stocks gone up in the fourth quarter? You have a couple of things happening. Mostly it's fund flows, obviously. So I always talk about that fund flows, which is more near to intermediate term stuff, by far trump any sort of structural and fundamental stuff, I should say. I call these actually structural analysis. Fund flows is structural, whereas fundamentals and that kind of stuff will be more fundamental. So in the fourth quarter, you've got a lot of those things happening. First of all, you got some people that have to maybe invest some gains for the year if they had gains. You've got people that have to do some reshuffling of portfolios. Sometimes that's a net gain. Some people invest and add money to their retirement funds or whatever it is, right? Some of that. That's the easy stuff to understand. What I think retail investors don't understand sometimes is I call it the performance anxiety. I talk about this every year in the fourth quarter. The performance anxiety of underperforming fund managers. Most fund managers underperform their index, right? More than 50%, whatever their benchmark is, whether it's the S&P or something totally different. So in order to make up for that, a lot of times they have to catch up and start chasing the market higher because they have career risk. They may not have a job come at some point the first quarter of the next year if they don't do that. And that kind of leads to a self-fulfilling prophecy. Everyone knows that the fourth quarter tends to be profitable. So there's a lot of incentive for fund managers to chase, which then gets other people to chase, which then if they do enough of that, then gets the algos to help them out, and so on and so forth. But this is also where the risk is this year. Again, I just want to be very clear, I really respect this dynamic. We typically take advantage of this dynamic. So it's, to me, very important to respect this. I'll give you a couple of ideas how we can play this. I've got a portfolio structure that I think makes sense here at this point. But also, I want to be clear that because this is happening, and everyone does this, if we do get a really bad data point, like for example, we had a taper tantrum, I believe it was 2018 in December, the S&P dropped like 14% or something in like a few weeks, or it was crazy. Now, we're at a point in the economic cycle, if we get a big default, or again, anything, I have no idea what it is, no one knows, by the way. And so if someone tells you they don't know what it is, they're lying, so you may want to stop following them. We can guess. I can give you a list of things I just said, but we don't know exactly specifically what it's going to be that's going to trigger anything like that. But we want to be mindful of it. And so because of everyone's going to be crowding into this potential fourth quarter rally idea, if we do get that shocking, whatever that shocking event, which is a higher probability at this point in the economic cycle, you could see a massive move in the other direction. So, that would get like S&P 500 in S&P 500 terms, get us probably very quickly down to 4,200, 3,900 ish, and maybe even below. Again, not a forecast, but I'm saying that could happen. So the question, of course, is with these two opposite things happening here, how can we make money? It's all going to be in how tactical do we want to be versus how much do we want to be allocating to a portfolio that right now actually makes a lot of sense to me, which I'll show you in a minute. For those people that just want to have fun and do a bunch of chart breakouts or chart breakdowns, which is fun, right? It's not an asset allocation model, and much more nervous and nerve-wracking, and usually the odds aren't very good of making money over time. There's going to be plenty of that. There'll be breakouts, there'll be breakdowns, and so on and so forth. However, from an asset allocation perspective, and remember, this is not investment advice here. I'm not allowed to give you investment advice on a webinar, by all means, or on a podcast, excuse me. But let me give you a basic idea of something that I think, and again, not advice, just as information, research, whatever you want to call it, something that I personally, for me, think is interesting. And I actually have a portfolio that's mostly set up this way right now. So what I'm showing here on the screen for those people that are watching, if you're listening here, you're not missing anything. Let me just give you some numbers. So what I'm showing here is a portfolio that's got essentially 4 positions. One position, and I came up with 60% of that position. That's not meant to be exactly specifically to the percent correct, but broadly speaking, is an allocation to something called the SGOV ETF, ticker symbol SG, so S as in Sam, G-O-V as in Victor. It's the 0 to 3 month T-bill ETF. It should throw off about 5.5%. It's got a monthly dividend, I believe, that it pays out. So 5.5%. And again, I'm going to call this risk-free because in the investment banking world, that is the risk-free rate, the investment rate. Now, some will say, "Sir, there's no such risk, such a thing as no risk." What we mean is, if you buy a treasury, a T-bill today, and you hold it for the next 3 months, that is essentially risk-free unless the government defaults, of course, the U.S. government, which I would argue very low likelihood of that. I think most of the market agrees. But if that happens, of course, then there's more risk. But a 60% allocation, so 60%. So that's a lot of money to make. That's 3 months. That's really sexy. If you think about trying to make 10% a year, you only have to make another 4.5%, 5% to get a full 10% somewhere else, right? Maybe it's equities. And I've talked about this in the past, earlier this year. Then there's another allocation, and then I came up with a random 50. Again, not totally random, but not meant to be exactly, let's say 15% to an ETF that is AG. Ticker symbol AGG. What it is the aggregate, basically, core US bond index. It has bonds in there from all across the yield curve, corporate bonds, so on and so forth. So if we were to get an event, right, and I actually think bonds are very oversold here right now. That's my personal feeling. If we get some sort of shocking event, again, whatever, I don't know what the news is, bad payroll number, I have no clue. That gets us to the point where bonds rally, even if it's just a very sharp bond bear market rally in bonds, that could really help that AGG ETF from a directional perspective, get stocks, get it to rally. So you've got, not only do we have an allocation here to, from a yield earning perspective in the SGOV ETF, but also AGG to take advantage of a potential really big rally in the bond market should we get some shockingly bad news. Again, that would probably be, again, there's other ETFs. This does not have to be the ETF that you take advantage of, but I'm just saying specifically. And then I've got a 20% allocation here in the SPY ETF. Of course, everyone knows that's the S&P 500. And that I want to have in there because, again, we do want to respect the potential for a Q4 rally, maybe a sharp Q4 rally, right? Seasonality does favor that, just maybe not as much in this economic environment, but we still want to respect it. That leaves us with 5% if you've done the math or you're looking at the screen, which I've marked here as money market. Basically, what the 5% would be for in this hypothetical portfolio, it's basically buy some puts in the S&P 500, and they can be put spreads as well. Anything to basically hedge and take advantage of a market plunge and the equity market plunge. Because if the equity market plunges, again, this is an if, then not only will the AGG ETF go higher, SGOV will make money either way, but it's also going to hedge your SPY long position. That's how we think. If the equity market doesn't, if it just melts higher, then SPIs can make money. Yes, you'll pay some premium back to the market by in the way of the options that we buy, premium we buy for SPY. But again, we'll still make money in STOF regardless, and the AGG ETF will probably be okay. We'll make some coupon there. And I don't think the bond market's going to go a heck of a lot worse here for the rest of the year. Famous last words, but that's what I think. So this is a portfolio. Again, it's not investment advice. I'm just showing you something that I think makes sense in this environment. So this is my little roadmap here for the fourth quarter as it stands here as we're entering the fourth quarter. It's been great fun being here as always. If you guys have any questions, please let us know. Just send us an email. You can send it to support@thesteadytrader.com. For those people interested in investment advisory, we have a separate business for that. That's www.bluemarlinadvisor.com. That's where we do advisory. We actually advise people on their portfolio because it's legally registered to do that. We manage their portfolio, or just advisory itself, where we actually call them on the phone with ideas and that kind of thing. And of course, thesteadytrader.com is where we do all our research, dissemination, indicators, tools, all that kind of good stuff, and trade alerts and that kind of stuff. Anyway, any suggestions for topics you want us to talk about in the Steady Wealth podcast, just, again, email support@thesteadytrader.com. Thanks for listening, and we'll see you in the next Steady Wealth podcast episode.